Hello friends, last week in my video, we basically discussed whether the elections could put a pause onto the rally. On your screen right now is the weekly market roundup, and what you can see is that it was the bank Nifty which again led from the front, whereas the Nifty 50 brought up the rear. Not really surprising because banking and financial sector stocks have a weightage of as much as 33% in the Nifty. If at all you want to boost the Nifty, you cannot do so without boosting banking and financial sector stocks. So the index management is unlikely without banking going up, which is why you're suddenly seeing interest in HDFC Bank and other banks, HDFC being the heaviest weighted, of course, rise up so steeply. Remember, nothing happens in the financial markets without a reason, and the reason is also financial. Now, the US dollar index came down by 25 basis points, which basically boosted gold and silver. Oil went up after the OPEC announced that they would maintain their output cut stand. Natural gas also went up in sympathy with oil after short covering started appearing up on the screens as I saw them. And the USD INR fell 9 basis points, which means the rupee appreciated marginally, which also added to the bullishness and support at lower levels. Now, Indian 10-year benchmark bond yields went up by 7 basis points, which means your bond prices fell, which is why I took you out of the 4 gilt funds when I did 3 weeks ago. Look at how the NAVs have come crashing down. The market capitalization on the NSE went up over 3%, which tells you that the rally was fairly broad-based, and the US markets fell across the board, even though towards the end of the week there was buying, but net week on week there were declines, and therefore there were some headwinds for our domestic markets. At the inset box, you can see that the Bank Nifty has over the last 4 week period started outperforming the Nifty 50. And do note what I told you, the weightage of banking and financial sector stocks is 1/3 of the entire Nifty. It's not really surprising that the banking and financial sector stocks are now leading the way forward. You can't boost the markets unless you lift these up. Now, friends, I come to our in-house indicators, starting with the MWPL. And MWPL, after making a lower high in the expiry of March and making a post-expiry low, which is lower, has risen routinely to 33.84%. It still remains below the 35.49 logged in a similar week last month. And that tells you that bulls are going cautiously. I'm not saying that MWPL cannot rise. Hey, it might just play catch up like a delayed train running faster to make good for the lost time. Now, where do you get this data? On my Telegram channel every evening, very late night maybe sometimes. And I update this on a day-to-day basis so as to help my online family stay abreast. Now, index and stock futures turnover, what you did see was index futures turnover went up a tad, whereas stock futures turnover came down. This is not really surprising because the rally in the turnover was also attributed to the expiry of the March derivative contracts. In expiry, traders tend to square up their positions in the expiring month and initiate the same positions in the next month, which results in double turnover. So turnover came down routinely. From here on, we need to monitor. This is again some data that I put up in my post-market summation every evening or every night. Friends, I now come to the NSE advanced decline ratio on a weekly time frame, and that too, it's an average of all trading sessions during the week. What you are seeing is that in spite of the fact that the Nifty making lower percentage gains last week, the advanced decline ratio zoomed up to a 20-week period high, which is covered in the chart, to 3.14, which means For every 100 losing stocks, there were 314 gaining stocks. Is this advanced decline ratio sustainable? I don't think so. Statistically speaking, the weight of evidence is against the sustainability of this advanced decline ratio. Why is it so high? I have a feeling part of this is also because of short covering. Now, this is again another metric that I share on my social media every day. Now, friends, I come to the basis. Basis is nothing but the premium or discount available in the futures compared to cash. Higher premium tells you that traders are willing to pay a higher premium to go long or even go short, but the risk appetite is higher. Last week, when I told you that these levels of 421 rupees on the Bank Nifty and 161 on the Nifty 50 were not sustainable, it was not without a reason. These kind of levels are places where the theta decay traders come out and short. Now, what is happening here? You need to understand, as you and me are traders, we are the risk takers, we are the market participants. We are not fireside experts sitting and commenting on the markets. What it means for us is, even though the Nifty spot may have gained, but we are not trading the Nifty spot or the Bank Nifty spot. We are trading futures. Our gains are muted. Our gains are dulled or compressed by the fact that the premium has gone down. So your take home money is lower in both the Nifty and the Bank Nifty, because even though the spot went up, the future prices compressed. The basis went down. As long as the basis is positive, which means the future is trading above spot, all is fine and bulls are still in the driver's seat. You need to worry only when the basis becomes negative or the futures trade at a discount to spot. Friends, I now come to impetus, our in-house indicator which you've trusted for more than 3 years now. Both the indices went up with rising momentum, which tells you that there was buying momentum and bulls were supporting the market proactively. Should this continue, I think the coming week may also see continued gains in the market. Impetus is also something that I share on my social media accounts. Friends, I now come to LWTD, an indicator that I've been swearing by and you've been supporting me with positive feedback for more than 3 years now. The Nifty, in spite of the fact it made lower gains last week, the LWTD or lift, weight, thrust, drag reading went up smartly from 0.05 in the prior week to 0.26 last week. That tells me that at lower levels, I should be expecting proactive support. Now, this is a weekly chart. The daily numbers are shared on my social media accounts. Friends, I now come to the bond market, which I have been leading the way in covering before equities since the longest time, since many, many years, because this is a fountain of money supply that propels the prices of all other asset classes. Indian bond yields simply zoomed to 7.11, which means bond prices fell. The RBI very clearly said that we do not want to tinker around with the repo rates, but they did. The Honorable RBI Governor mentioned the word inflation at least 6 times during his almost 45-minute speech. That tells me that the RBI is an inflation hawk. Unless inflation comes to 4% or lower, I think the possibility of a rate cut seems to be on the back burner. It's open, but it's on the back burner. If the Fed cuts rates, we'll have to cut rate due to cash carry considerations. But as of now, I don't think it's happening. And do remember, the RBI has very clearly said they would be borrowing 7,50,000 crores from the bond market between 1st of April 2024 to 30th September 2024. Partly to redeem the old debt which is coming up for redemption and partly for new financial requirements. So, which is one reason why we are glad we are out of our 4 gilt funds, because the NAV has come down. The possibility of further declines in those NAVs cannot be ruled out. What am I going to do now that yields are at 7.11? As far as I'm concerned, the yields are in no man's land. Give me at least 7.3 or higher, possibly even higher, before I start buying RBI's 10-year benchmark sovereign guaranteed bonds all over again. Till then, I'm sitting on the dry powder waiting for my next move. Where will I update this? First and foremost on my Telegram channel. Do connect with me there. Friends, the bond market done. I now come to the Bank Nifty, which gained 2.90% last week, and it rallied on 4 out of 5 trading sessions last week, as you can see on the daily chart of your screen on your screen. Do remember, banking and finance has weightage of almost 33%, and therefore, without the Bank Nifty, the Nifty cannot be boosted. Now, as you can see on the chart, Thursday was a pretty critical session where the markets opened with a gap up, but at higher levels there was a lot of jitters, a lot of selling, and what we do see is a long leg doji, which means the body of the candle, the open and the close, are somewhere in the middle, close to each other, and there are long shadows both on the higher and lower side. So there was a big tug of war, and the markets ended where they almost opened at. Now, once that high of Thursday was overcome, the Bank Nifty surged ahead, and very clearly what we see was a sterling performance, at least as compared to the Nifty 50. Now, do note what I told you previously in the in-house indicator segment on the basis. How you make smaller gains due to basis compression is right here. Your Bank Nifty spot chart will show you gains of 1,368 points, but the futures will show you gains of 1,113 points. Why? Because the basis contracted. So your take home was actually smaller. As real world traders, you and me are brain warriors. We win with our ideas. So let's keep our mind sharp and think about all possible expenses that we incur in trading before we start dreaming about the potential profits. The price is comfortably above its month-long moving average, which itself is pointed higher. Therefore, the short-term outlook is positive for now. The price is above the swing high of 6th March 2024, and it's a whisker away from the all-time high of 48,869 that it made on 1st January 2024. Turning to the weekly chart on your screen, what we are seeing is a fairly prominent size bullish candle with a real body where the price is nearing the all-time high. The price is above its 6-month-long moving average, which indicates that the medium-term outlook is also positive. The average itself is pointed higher. So, as long as the buy and hold investor is witnessing higher and higher prices week on week, he is under no compulsion to sell. The weekly low at 47,280 needs to be defended in case of declines, and as long as that happens, I do not rule out further upsides in the market. Friends, in the week before last, this index was at number 8 as per statistical beta rankings that we maintain in-house. It jumped 5 notches to number 3. Not good news, because higher volatility would mean higher challenges for the average retail trader. Last week, I advocated a range between 48,500 on the upside and 45,750 on the downside. Note how, in spite of all that thrashing about and high volatility, the high was 48,557, merely 57 points higher than our resistance. In the coming week, I anticipate an estimated range between 49,875 on the upside and 47,125 on the downside. Friends, please also watch and monitor our daily, weekly, and monthly pivot points that we update on our free Telegram channel. They'll help you pinpoint your trades even further. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.84% on a week-on-week basis, but it rose only on 3 out of 5 trading sessions, unlike the Bank Nifty, which rose on 4 out of 5 trading sessions. Here again, Thursday was a very nervous day, as you can see on the daily chart on your screen. It was the banking and financial sector stocks that boosted the Nifty. Otherwise, the Nifty could have ended the week with smaller gains. Note in the inset box how I'm reminding you again as the Bank Nifty is outperforming the Nifty 50 on a 4-week time frame. The hacienda hedges or the tail risk hedges that I have been warning you in my videos and in my live mint column, they've been basically keeping us stress free since the last 5 weeks on our existing long positions, but for which we would have basically had a lot of stress disorders. The price is above its month-long moving average and the average itself is pointed higher, so the short-term outlook remains positive. The Nifty is near its all-time high made on Thursday, so it's near the blue sky zone. The weekly chart on your screen tells you that the body of the candle is far smaller than the prior body, and in relative comparison with the Bank Nifty, the Nifty appears to be on shaky grounds. Relatively, not absolutely. Now, that small spinning top candle indicates indecision and some amount of caution, but it can be negated, it can be overcome by a strong rally above the weekly high of 22,619. On the flip side, a sustained trade below the Fibonacci extension of 261.8%, which falls at 22,200. If the Nifty was to trade below 22,200 sustainably, there could be a deeper correction. Now here, for now, the price is above its 6-month moving average, so the medium-term outlook is also positive. Friends, in the week before last, this index was number 16 as per the most volatile counters list. It jumped 3 notches to number 13, and that means higher challenge levels for an average trader. Last week, I advocated an estimated range between 22,825 on the upside and 21,825 on the downside. These ranges held in spite of all the volatility. In the coming week, I estimate ranges between 23,000 on the upside and 22,025 on the downside. Do please monitor our daily, weekly and monthly pivots on our free Telegram channel. They'll help you be a lot more precise. Friends, now for the last bit of statistical analysis wherein I share the risk appetite of the retail trader by way of the turnover contribution in the 4 segments of the F&O segment. The index futures contribution remained steady. The stock futures contribution to the turnover fell by 29 basis points. That tells you that risk appetite was lower. Index options saw a rise of 0.03% in the turnover contribution, whereas stock options saw a 0.26% rise in turnover contribution. Overall, the fact remains that turnover contribution was higher in the lower risk option segment rather than the futures segment. I would say that risk appetite was lower. I have made a video about what happens when traders switch from futures to options. What should you read into it? It's a short 60-minute video. The link to it is below in this video in a pinned comment and in the description. Friends, I now come to my strategy, what I would do in the week ahead, and I continue to focus on public sector undertakings, the PSU stocks, especially those counters where the MWPL or market-wide position limits have remained elevated. I keep watching energy stocks because the oil marketing companies and the energy stocks are likely to see impact on their stock prices from the wild swings in oil and gas prices. Combined with a weak US dollar, combined with a weak Indian rupee, that could basically trigger higher volatility than there is already in these volatile counters. I think financial and banking stocks need to be watched more carefully due to the 33% weightage in the Nifty, and index management is not possible without their participation. I will continue to seek theta decay opportunities in the oil and gas segment at higher strike prices because prices are gradually nearing a place where demand compression might be feared in the energy sector. As I have been mentioning in my live mint column, bullion is getting support on all declines, and yes, this time it's different. The US presidential cycle standard operating procedure is to suppress gold prices and boost dollar prices, but it's failing. The fact that bullion prices are rising higher ahead of the US election tells me that after the US elections, when pressure on prices to subdue them is taken out, prices might just jump even higher post November 2024 after the US elections are done. Thank you for being with me in this long video. Till we meet again in my next, this is Vijay Bhambwani signing off for now, but not before reminding you to subscribe to my YouTube channel if you haven't already done so. And in the comment segment, do let me know how my videos help you become a better trader. Also, help me reach out to fellow like-minded investors like yourselves by sharing my work on social media. Have a very, very profitable week ahead. Take care. Bye-bye.